Now I would like to talk about some useful tools for identifying market sentiment. At certain times, they might contradict each other, therefore I suggest that you base your decision on them only when they confirm each other. That way, you will significantly increase your chances to be right with your prediction. One thing you should do is to manually draw lines that connect important price levels. By the angle of the outcome, you can learn a lot. We will discuss this in the next videos when we will learn how to draw trend lines and support or resistance levels. But before that, I want to show you 3 strong automatical tools you can use. These are indicators that make life easier for you. They calculate recent developments and let you know about the current market state. In addition, they are useful for other purposes, but for now, we will focus on how they help us to identify trends. The first one I want to talk about is exponential moving average, which is a very important tool to use in technical analysis. There are few ways to use it, but for now all you need to do is very simple. Open the chart you want to test, add a certain EMA, and look at it. If the slope is going up, then you have an uptrend. If it's going down, then you have a downtrend. If, however, the line has not reached any significant new high or low in the last 20 to 30 candles or more, then you know that this is a trading range. For example, let's go to this Litecoin USD daily chart. We will add the exponential moving average from here. We will type EMA, and there it is. In order to change its setting, all you need to do is click somewhere over the line, then right click on your mouse and go to Format. In the length, you enter 13, choose OK, and that's it. As you can see, at this part the slope of the EMA is clearly positive. We have new highs and the market is trending upward. At this part, however, the slope is negative and you can clearly see the downtrend. But look what happened before that. Dozens of indecisive candles. The slope is going up and down, and no new significant high or low is recorded. All of these signaling a trading range. Another useful indicator you should be familiar with is the MACD. Besides being a trend following indicator, it also measures the momentum. There is the MACD line, which is calculated by measuring the difference of the 26 and 12 EMA. And there is the signal line, which is a 9 candles EMA of the MACD line. Whenever the signal line is located above the MACD line, then the prices are currently going higher. If it's located below the MACD, then it would reflect these lines. However, it's not enough just to see if the signal line is now above or below the MACD in order to identify a trend. It will always be above or below it, even when the market is ranging. In order to identify a trend, you want to see at least 10 candles without crossover to the opposite direction. I suggest that in order to test the validity and strength of a trend, you also use it in combined with the ADX indicator that we will now talk about. But before that, let's just have a look at the MACD with the same Litecoin USD chart. You already know how to add it to the chart, so we will skip that part. Here you can see the pink MACD line and the blue signal line. At first, the market was ranging. The signal line was playing along by going slightly above and then slightly below the MACD line. But they were too close to each other, and each crossover couldn't last more than a few candles. Then the signal line was crossing the MACD upward, signaling an uptrend. This trend was strong and short. During this candle, you can see a big difference between the two lines. It indicates a sharp and quick movement, and it usually doesn't last much, as the two lines' tendency is to be closer to each other. Then the signal line crossed the MACD line again, but this time downward. This trend was more stable. It lasted about months and a half, and as you can see, all of this time the signal line was still below the MACD. And now we will talk about the ADX. This indicator measures the direction of a trend as well as its strength. It consists of 3 lines, the plus DMI, which represents buying power, the minus DMI, which represents selling power, and the ADX itself, which is derived from the relation between them. So first thing we want to know is the overall direction. If the positive DMI is located above the negative DMI, then we have an up movement. And if the positive DMI is located below the negative DMI, then we have a down movement. Then, once we know the direction, we need to know if the momentum is strong enough in order to create an actual trend. So we have a look at the ADX line itself. The higher the value, the stronger the trend is. When you read it, remember that below 25 does not reflect a significant trend, so the market is probably ranging. Above 25 indicates a meaningful existing trend. Now let's return to the same chart and see how it looks like. Here are the three lines. The green one is the positive DMI, the red line is the negative DMI, and the black line is the ADX. It was around here that the plus DMI crossed above the minus DMI. It kept above it for a while, letting us know that the direction is up. At around this candle, the ADX went above 25, indicating that the trend might be serious. And indeed, we all know what happened next. At around here, the ADX got to an extreme level, and it was likely that it will start returning back. And this is exactly what happened. And at this point, the negative DMI crossed above the positive DMI, letting us know that the uptrend might go to an end. In this down momentum, it took some time for the ADX line to reach higher values because part of the recent declines was merely a pullback of the increases that came before.